Good afternoon, and thank you for joining us today. I'm Bruce Tatters, CEO at Red Cloud Securities. Today's webinar features Seabridge Gold, the premier gold and copper exploration development company that exists in the capital markets today. As I've mentioned many times, all of its projects are domiciled in politically secure regions of Canada and the US, and Seabridge Gold ranks number one in gold reserves per share and number one in gold resources per share among all North American listed gold companies. This leverage to gold is particularly well demonstrated recently by the overperformance year to date of Seabridge versus all the senior and mid-cap gold producing peers. Also, in addition, I'm sure that Rudi will highlight the very large copper resources that Seabridge boasts. We're extremely privileged to have Rudi Fronk, Co-Founder, Chairman, and CEO here to provide a general update and outlook for the company. In addition, we're also super excited to have Jim Anthony, Seabridge Co-Founder and well-known economic commentator, with us today to provide an outlook on the gold market and an update to investors on the dramatic changing events in the global landscape. Hopefully, Jim will share some wisdom on how things might unfold as we make our way through the balance of 2024. As always, we'll begin with Jim's comments prior to discussing Seabridge with Rudi. After the formal presentation, we will take questions live. Please send us your questions via the chat function on this webinar, and we'll get to as many as we can. You can type in your questions into the chat box at any time. For Seabridge, I'm going to remind everybody of the disclosures that are available on the page 2 of the corporate presentation Rudi's going to share. And for Red Cloud Securities, I'd highlight that this webinar is for information purposes only and should not be considered a solicitation to purchase or sell securities. I want to always recommend that people do their own due diligence and take into consideration their own personal circumstances before making investment decisions. So that's it for the disclosure. So now let's turn it over to Jim and Rudi to begin.
Thanks, Bruce. Appreciate the opportunity of presenting here today. As in the past, we'll let Jim kick off the presentation on the gold market. But just want to remind people that both Jim and I will be making forward-looking statements during today's talk, and I welcome you to go back and look at what this means in terms of our forward-looking statement slide.
Thanks, Rudi. Well, welcome to the stealth gold bull market, the one that really shouldn't be happening. If you look at the old rules, there should not be a gold bull market today. There's positive real rates of interest. That should be a negative for gold. Gold should be down. The dollar is strong, solid at least. Gold should not be up. Rate cuts, well, at the start of the year, we were looking at between 6 and 8 rate cuts this year, according to market dynamics. Now it's down to 2 or less. Gold is up. Not supposed to happen. And if you look at COMEX contracts over the last month, actually down 36,000. Not supposed to happen in a rising gold market. This is a strange one. But there are reasons for it. And the number one is that this is no longer our commodity in the West. This is no longer a passive asset. Next slide, please. So the East is buying while the West sells. And the reason is very simple. The East is outbidding the West. They're paying more for gold. And if you look at the Shanghai-London gold premium, it rocketed in 2023, averaging $29 an ounce or 1.5%, the highest in history. And, actually hit $120 an ounce on September 14. So it pays for people to buy gold in London or New York and sell it in China. And that's what's going on. If you look at the gold tonnage versus the gold price on the left, that's GLD. GLD is on the way down. That's the black line. Its holdings have been diminishing for 2 years now, whereas the yellow line, gold price, goes up. This is very unusual. As you can see historically, they usually track each other. And if you go to the right, bottom right, these are the ETFs for physical gold globally. Same story, even more. The white line is the ETF holdings going down sharply. The blue line, gold price. This is very unusual for a gold bull market. Next slide. And one of the reasons is that gold is becoming, once again, an oil currency. 20% of global oil trades in 2023 were done in non-dollar currencies, up from 0 in 2021. And as you can also see from the chart to the right, Swiss gold exports have increased to the Gulf Coast Council countries. Those are the oil exporters, by the most in 10 years. Oil is now being traded in gold rather than just dollars. Oil importers are using their currencies to buy oil, with final settlement in universally accepted central bank gold. The leader in this area is Russia and China, who entered into a deal last year that started up on January 1 of this year. And there's significant quantities of oil going to China, and China is paying for those in yuan. Russia uses some of those yuan for Chinese goods and services, but they're taking back the excess in gold, trading those yuan back to the People's Bank of China for gold. So the oil price will now be another price driver for gold. This is new. And it's becoming an active asset, not just a passive reserve asset as gold used to be and as it still is in the West. The US has made the dollar as good as gold for oil in the 1970s. That was one of the great accomplishments of Dr. Kissinger, working with Sheikh Yamani, who was the Secretary General of OPEC and the Saudi oil minister. And they figured out that with the gold, with the dollar off, the US dollar off gold, that the US would nonetheless make sure that it was as good as gold for oil, so that the oil exporters, principally the Saudis at the time, did not have to worry about the value that they got in exchange. That isn't working anymore. Next slide, please. Central banks are the biggest gold buyers. So the purchases in 2022 and 23 were at record levels. Massive buying is required nonetheless to get back to historic levels of 40%. It would take about $3.2 trillion of additional central bank purchases just to get back to where they used to be. And we think that's in the process of happening. Price insensitive buying has broken the old relationships, such as inverse correlation to real interest rates. Central banks don't care about real interest rates in the United States. So gold is actually replacing dollar-denominated assets in central bank reserves. This is happening slowly. We don't expect to see the US dollar lose its hegemony in terms of its role in central bank reserves or its role as a trading currency globally. But there is another part of the world now that is not dollar denominated. And as that part grows, it's going to put additional pressure on the gold price. So you can see bottom right, this is the foreign central bank transitioning toward gold. The white line is the percentage of its reserves that are in treasuries, obviously on the way down. The blue is the gradual beginnings of a transition toward additional gold in central banks. And the chart above on the right, the World Gold Council estimates the lines in blue that tell you what actual purchases are occurring in central banks vis-a-vis the reported amounts in red. Next slide, please. So Western gold ownership is low and falling. In it, it's quite extraordinary. Gold is now about half of 1% of investable assets versus about 2% historically. So it's never been that high, but it's certainly been much higher. There is no room for Western buyers to get into this market without an enormous price run. So this is a gold bull market with almost no participation from the West. Gold shares are near historic lows versus gold price. So that's where, the Western investor is going to get back into this gold bull market. You can see the upper right chart that, the shares versus the gold price have rarely been this low. It's near a record. It's unbelievable how the shares have collapsed against gold now with the gold bull market and Western investors looking for a chance to get in. We think this is going to take off. If you look below on the right, the asset allocation, 72% of advisors, or 71%, sorry, of advisors and asset managers have little to no exposure in gold, less than 1% of assets. And on the left, the chart there, you can see that, and this is now outdated, the way gold has been moving over the last month. But if you look at that number, you need to see at least an 85% increase in the share prices to begin to reflect what's happened to the gold price. Next slide, please. There's also stuff going on in the foreign exchange market that is going to end up, we think, very relevant to the gold price. And perhaps the most important is the yen carry trade, which we now see as coming to an end. Negative interest rates have encouraged Japanese investors to invest abroad and foreign investors to borrow in yen for investment in foreign markets, especially treasuries. There was obviously a huge difference in interest rate. Japanese portfolio investments, that's stocks and bonds, abroad, that is outside of Japan, equals 531.3 trillion yen, or about $3.54 trillion. The Bank of Japan implemented negative interest rates and yield curve control in 2015 to counter deflation and create inflation. They actually wanted inflation up. These policies, negative interest rates and yield curve control, have finally worked. Wage and price inflation are rising. Real rates are still very negative, however. So it is very likely that we're going to see ongoing rate hikes. They're now expected in Japan. Its policy was reversed, that is NERP and YCC, just last month. So we expect to see capital will flow to Japan. So we should see the yen up, dollar down, and more Fed support will be needed for the treasury market as Japanese money goes home. This is good for gold. In 2015, bringing in the negative interest rate policy dropped the yen 20%, popped the dollar, and helped make the gold market bottom of $10.45 in 2015. Next slide, please. And one other thing to keep in mind, the sovereign debt doom loop that has been prognosticated for many years is finally here. David Hartnett, who's the CIO, Bank of America, predicts annualized Treasury interest expense will hit $1.6 trillion by the end of this year, becoming the largest single budget item. Fed rate hikes have driven the U.S. deficit and debt into hyperdrive, likely reaching Hartnett's prediction $40 trillion by the end of next year. A higher deficit raises borrowings, increases interest expense, which increases borrowings. So this is why I think it deserves to be called a doom loop. And Treasury issuance is now mostly short duration, which is what you get in emerging market countries. And the interesting thing is that the shorter the duration, the more the securities are like cash. They're more like money. It's more like QE. Goldman Sachs, another thing to consider, predicts that 300 regional banks may go bust due to commercial real estate defaults and the Fed policy of staying higher for longer. If you look to the right, this is a chart by the National Business Economic Research Council, and it indicates that if you, there's about $1 trillion worth of commercial real estate mortgaging and financing coming due this year, 2024. And across the bottom, you see the estimates or various possibilities of how much of that will go into default and the number of banks that will then become insolvent. So at about a 16% default rate on the mortgages and other financing vehicles, you get a 300 number in terms of bank insolvencies. This is serious stuff. And, I don't think it's been fully accounted for in thinking. What we'll see as a result is that the Fed will be forced to cut rates, probably more than anticipated at the moment, because they will need to reduce the pressure on the banking system, and the dollar will be sacrificed. So next slide, and over to you, Rudi.
Okay, thanks, Jim. Every time I hear one of your presentations, I think I should go out and buy more gold. But I think I'm pretty loaded to the gills right now, so I'll just stay put. So when Jim and I co-founded Seabridge, hard to believe it was 25 years ago this October, we had two important guiding principles. The first was avoid political risk. Jim and I had mines that we had built, confiscated by governments. Political risk is real in our space. So if you look at our asset base today, we are exclusively focused on North America, Western Canada, and the United States. We have two advanced stage projects, KSM in British Columbia and Courageous Lake in the Northwest Territories, and three earlier stage exploration plays, which we believe will become company makers in their own right going forward based on exploration opportunities we see there. I thought today what I'd focus on is what's new at Seabridge. We had a very busy year last year at all of our projects. Our second guiding principle that we put in place 25 years ago was to try and create optionality and leverage the gold price by simply growing ounces in the ground faster than shares outstanding. And on that, we've delivered. In fact, with recent announcements, we can point to an increase of 9.2 million ounces of gold coming from KSM and Courageous Lake, which more than offset the dilution we suffered last year, raising dollars to get this work done. Also, over the past couple of years, we've been focusing a lot on KSM, doing early site construction activities to ensure that our permits will be good for the life of the project. And on January 16th of this year, we actually filed our application for substantially started status with the BC regulators about 2 months ahead of schedule. We've talked many years about a joint venture. Last year, we engaged RBC Capital Markets to run a formal joint venture process. They are doing a great job for us, bringing the large companies into the tent to look at KSM as a joint venture opportunity. As a result of their outreach, we actually had 5 new companies last year come and visit KSM for the first time during their on-the-ground, boots-on-the-ground technical due diligence. And our dialogue is continuing with a number of those potential partners as we move forward. Our expectation is to bring a partner in that will provide most of the capital required to build this mine, where we keep a meaningful stake in the project. I think the market has lost focus of our company, just equating us to KSM. In fact, the market forgets that we actually have another large project in the portfolio called Courageous Lake, where we had done some early work on that project earlier in our life, and then kind of set it aside as we were having tremendous success at KSM. We've now moved back to Courageous Lake, and just earlier this year, we announced an updated pre-feas that can show a potential for a mine approaching 30 years of mine life, producing about 200,000 ounces of gold a year over that mine life. And then last but not least, we are now fully funded for $18 million worth of new drilling this year, 12 million of it to be spent at Iskut, which we believe can be another KSM in the making, and about 6 million to be spent at Three Aces in the Yukon. If I use one chart to tell our history, this would be it, simply showing our ounce count relative to our share count. Our optionality and leverage to the gold price comes from our ability to offset equity dilution with ounces in the ground, essentially looking to grow ounces per share year in and year out. And as you can see here, over our life, we've delivered on that, actually growing ounces in the ground 5 times faster than shares outstanding. And when you look back at that compared to the industry, we've done a really good job there. In fact, if you look at us today relative to other better known gold stocks, we actually provide 5 to 50 times more gold ownership per common share, whether you look at it in terms of reserves per common share or gold resources per common share, than any of the leading gold companies. And the expectation on that business strategy was that our share price would outperform the gold price and other gold equities in a meaningful way. And as you can see here on this chart, over a 25-year history, yes, the gold price is up from about $260 an ounce to over $2,300 today, but our share price has significantly outperformed that move in the gold price. I'm always amazed looking at this to see how poorly our industry has done in terms of providing optionality and leverage to the gold price. Investors buy gold stocks with the expectation that if the gold price goes up 10%, the share in that company I'm buying should go up more than 10%. In fact, our industry has under-delivered on the concept of leverage and optionality. And when we look at the reasons why, I think the simplest way to show it is equity dilution not being offset by production or reserve growth. This is just a table that takes some simple numbers from some of the largest gold mining companies on the planet, the better named companies, Barrick, Newmont, Kinross, and Agnico Eagle, showing what happened to their share count from 2007 to the present. Each one of these companies has more than doubled their share count over the time period, yet their production is flat to down, with the exception of Agnico Eagle, and the reserves are flat to down as well. And when you equate this back to per share metrics, these big companies have destroyed per share metrics. If you look at the drop in terms of reserves per common share, production per common share at Barrick, Newmont, and Kinross, no wonder their shares have underperformed the gold price in a meaningful way. They continue to destroy value to their shareholders on per share metrics. Agnico, on the other hand, is the one company that I look at that gets it right. Yes, they've grown their share count, but they've also grown their production count. And while they were increasing their production, they also kept their reserves per share pretty steady, unlike the other majors on the planet. The only other gold stock I own for the majors is Agnico Eagle, and it's for that reason. We talk a lot about gold. We also have a lot of copper, as Bruce mentioned in the introduction. If you ignore all of our gold, all of our silver, and all of our molybdenum, and just look at our copper resources or reserves on a per share basis, we provide more copper per share than the leading copper companies. Another concept of optionality and leverage, if you take all the metal we have in the ground, gold, copper, silver, and molybdenum, at today's metal prices, and divided by the number of shares we have outstanding, today we're backed by over $7,000 US of metal in the ground per share. We're trading at about $16. That's where the leverage comes from. That's where the optionality comes from. And that's where the future growth in our share price will come from. I'd be remiss if I didn't have a few slides on KSM in this presentation. KSM has obviously been the driver of the value over the past 15 years or so. It's an asset that has grown tremendously over the past 15 years. We call it a project, but it's really a district. We have 5 deposits at KSM, which give us over 12 billion tons of economic resources, 3 of which are gold dominated, Mitchell, East Mitchell, and Sulphurettes, and 2 of which are copper dominated. The growth we had in resources at KSM resulted from updated resource models at Ironcap and Kerr, using the same metal prices that were used in the other 3 deposits in last year's 2022 technical report. That technical report was done at a base case gold price of $1,742 an ounce. Obviously, the gold price is a lot higher than that today. But even at that lower gold price and lower copper price, we're able to show a very robust project producing over 1 million ounces of gold a year and about 178 million pounds of copper a year at an all-in cost of production of about $600 an ounce, generating a double-digit IRR and a $7.9 billion US after-tax net present value. If you play with those numbers and actually just start looking at the optionality and leverage that this project holds to gold and copper prices and use $2,200 gold and $4 copper, you see an increase in the net present value going from $7.9 billion to over $12 billion on an after-tax basis. I'll have to updating the slide, Jim, as the gold price goes higher, but It's a fun exercise to go through.
You bet.
Obviously, a project like KSM and most gold projects show leverage and optionality to higher gold prices. What about lower gold prices? How does the project test a stress test in terms of looking at lower gold prices? So if you look at this alternate case here where we ran the same set of numbers but using $1,500 gold and $3 copper, you still see a project here that can withstand these lower metal prices and still generate double-digit returns and decent net present values from the lower gold price environment. The other, I think, important thing to look at is also looking at the sensitivity to higher capital costs or operating costs. If you were to increase capital costs here by 20 or 30%, again, you still show a project that has tremendous financial returns of double-digit basis with higher costs. And by the way, that mine plan only captured the 3 higher grade gold deposits. It ignored Kerr and Iron Cap. In that updated technical report from last year, we also showed the impact of then starting to mine those 2 other deposits after that 33-year mine plan was done, adding another 39 years of mine life, but turning this project into a gold-dominated project to one that actually can generate more than 50% of its revenues from copper. That really is a unique thing about KSM. I'm a mining engineer. In my career, I've never seen a project with this much flexibility and optionality. For a copper company that wants to dominate copper production here, go after Kerr and Iron Cap. For a gold company that wants to dominate the production from gold, go after Mitchell, East Mitchell, and Sulfurettes. You have this embedded flexibility and optionality where you can decide whether it's going to be a copper mine or a gold mine or a little bit of both. One other thing that sets KSM apart from other big projects is we have actually successfully gone through our environmental approval process with permits in hand for construction. We started the environmental assessment process in 2008, got our approvals in 2014. Those approvals are now good until July of 2026. Fortunately, in British Columbia, there's a mechanism known as substantially started that if we can get this designation, the permits don't expire in July of 2026. They're good for the life of the project. So in 2021, we decided to go out and raise the money in a non-dilutive fashion to fund early site construction to be in a position to get substantially started designation. We did 2 financings with Sprout Royalties and Ontario Teachers Pension Plan, raising over $300 million US by issuing secured notes that convert into royalties at commercial production. We've now spent that money wisely, advancing infrastructure on the ground. And as I mentioned, in January of this year, we have filed for that designation. Just to show you some up-to-date photos, this is the camp we built right off of Highway 37, 210 beds right at the doorsteps of KSM and right next to an existing highway. A big part of KSM is also our ability to tie into the local infrastructure for power generation. The government of Canada has spent over $700 million bringing cheap green hydropower to the district. We are now building the switching station with BC Hydro. We spent about $90 million on this facility so far, which will allow us to take power off the grid and up to the site on a very cheap and low-cost basis. And, by the way, green. When we bought this project from Placer Dome, there were no roads. We're now building roads here. To the right, you can see the Treaty Creek access road that comes right off of Highway 37 past our camp and will eventually connect with the mill and the tailings facility location. And a second road to the left there that's coming down from the old Eskay Creek mine road that'll tie into the 5 deposits in the valley. A big part of our environmental approvals circulate around fish and water. When you impact fish habitat in Canada, you need to build offsetting fish habitat sites to make sure the fish have someplace to go. So this is now one of our showpieces here. We built our first fish habitat site right off of Highway 37. You can see just to the right there on this photo, and right next to the Bill Irving River, where the fish will come into the site up that little structure you see in the foreground here. We expect to open this fish site later this year. We'll probably have a fun opening party there, and unfortunately no fishing rods will be allowed. And then last but not least, bridges. We built our first big bridge crossing across the Bill Irving River. This is the bridge that'll service the project Life of Mine, where we'll bring supplies into the mine from the Port of Stewart up Highway 37, then across this bridge up to the site, and then also we'll be able to take concentrate out. So that bridge has now been completed and fully operational. I'm going to switch now to give you an update on Courageous Lake. Courageous Lake, if you've listened to my presentations over the past few years, was not really something we talked about. Yes, we did do a pre-feas at Courageous Lake in 2012 at a time when the Canadian dollar was essentially at par with the US dollar, which is not good for Canadian assets, and also at a time when the gold price was much lower. People are surprised to hear that we actually have a second 15+ million ounce project in Canada that's 100% ours, but we do. We did an updated pre-feas on this project earlier this year, announcing a project that can produce over 200,000 ounces of gold in initial mine life pushing 12 years at an all-in sustaining cost of production of about $1,000 an ounce. And that only captures about less than 20% of the known resource we have there. We then also did an embedded PEA to show how you can add another 20 some odd years of mine life on top of that to extend the mine life well beyond the initial 12-year period. And then if you start looking at this project, not just at the base case gold price of $1,850, but at today's gold price, you see a project that's very robust from an economic perspective. I'd say right now in our market cap, we get no value for Courageous Lake. We're going to change that. This project should generate value to our shareholders. And as a board and as management, we are going to go out and find a way to do that. Probably the simplest way to do it is to go out and try and sell this asset and perhaps keep a stream on it, perhaps a joint venture. But rest assured that we will now find a way to bring value to our shareholders on this asset by bringing it back into the spotlight and advancing it through one of those techniques. As we did the updated study, one thing we concentrated on was looking at a project that is more permittable than perhaps the previous pre-feas was. So we actually shrunk the footprint of the project dramatically. We shrunk the throughput. And as you can see here in the new project layout, it is a very, very tight layout. When you construct a mine, especially in the Arctic here, you want to keep all your infrastructure as close together as possible. And we've accomplished that now at Courageous Lake. I'd be remiss if I didn't talk about our exploration plans for this year. We're well known for our ability to identify projects early on, get working on them, and then grow ounces. That's how we went from 0 ounces to the ounce count we have today while keeping share count low. We now have raised $18 million in our treasury for fully funded exploration programs, 12 million of it going at Iskut and 6 million at Three Aces. At Iskut, we continue to believe that we have the potential for another KSM. The more work we do at Iskut, the more convinced we are that there's opportunities to find large gold, copper, porphyry deposits there. And we're going to put that to the test this year, testing 3 different target concepts we have at Iskut for big gold, copper, porphyries. At the same time, when we bought this project, a small resource came along with this known as Bronson Slope. We did a bunch of drilling last year at Bronson Slope. And over the next 30 days or so, we'll be announcing an updated resource estimate, which will further add ounces above the 9.2 million ounces we've already racked this year at our other projects. Three Aces is the most recent acquisition we did, a large land package in the Yukon. In fact, it's district size potential, over 300 square kilometers, over 30 kilometers of known gold mineralization running up and down the project length. Last year, we did our first drill program, large program, just to confirm our geologic models. This year, we're now going in to identify zones through additional drilling to where we can start to rack up resources with future drill programs. We have been so successful in the past in terms of finding ounces of projects we've acquired, and we now have two that we're going to get working on in a meaningful way over the next this year and next. And I'm not even going to bring up Snowstorm, which is a third project we have in the portfolio, which sits in Nevada. So why do I have over 90% of my family's net worth in Seabridge common shares? Well, I, for one, like Jim, believe that the price of gold is going to go substantially higher. If it is, our share price should do what it's designed to do. As Bruce mentioned, we've had a really good breakout this year relative to gold and other gold stocks. Simply put, if the gold price is going to higher levels, which we think it is, or even copper, our share price should do what it's done in the past, and that's provide exceptional returns to our shareholders. Second, we're now in a world where the big copper companies need new projects. If you look at the future projected demand for copper relative to mine supply today, new copper mines have to be built. There's not a lot of them to go after out there, to be honest, in safe jurisdictions. And we're sitting here with the largest, not only the largest undeveloped gold gold project in the world, but also if you just ignore our gold, it's actually the third largest undeveloped copper project in the world. We think it's time to get a deal done. We're very excited about where our joint venture process is going. Our goal in a joint venture is to maintain a meaningful interest in the project while minimizing our capital contribution and hopefully putting our capital contribution as far into the future as possible. And then last but not least is our continuing ability to offset equity dilution with accretion in ounces. We now have 3 new projects in the portfolio, which over time we believe will provide that continued growth of our ounces in the ground on a per share basis. Bruce, I think that's probably a good time to break and take questions.
Thanks, Rudi. So listen, I think from a question standpoint, they're very heavily skewed to you this time. Sometimes we get them skewed to Jim, but they're very heavily skewed to you. I always have questions for Jim because it's a wonderful, wonderful learning experience every time we do one of these. But why don't we start with you, given that you've got the balance of the questions, and then I'll fit in Jim in between them. Does that make sense this go round?
Absolutely.
It does.
Okay, so first question, and it's probably our favorite question every time we do a webinar, Rudi, since I've been working at Red Cloud, and that is, talk to us a little bit about how the discussions with the I got about 7 or 8 people asking me on the JV for KSM. So how are the discussions? Do we think that they're going to take place over 2024, or does the recent rise in commodity prices potentially get more people involved and extend them past 2024? And it just in general, can you give us some color without all the details on how it's going?
Sure. I mean, look, higher metal prices is a good thing, especially for a project the scale of KSM. And my experience in the business, and I've been doing this a long time, is that the big companies tend to do their transactions when the wind is at their back. Right now, from the metal price perspective, clearly the wind is at their back and perhaps about to blow harder. Maybe not so much from the equity side. I mean, Jim pointed out how low equity valuations are in the gold space relative to the gold price. So maybe we don't have the wind at the back there yet, but that's going to come. Is this going to bring in more partners? No. The fact of the matter is there's a limited number of companies out there that have the technical, financial, and social wherewithal to build a mine the size of KSM, maybe 7 companies. And those are the same companies we've been engaged with on a number of years. We have turned down proposals in the past from a number of these. Have we been demanding in our negotiations? Absolutely. But this is a once-in-a-lifetime opportunity on this project, and we're going to do the right deal with the right partner under the right terms, and that's what we're committed to deliver. We expect to get a deal done this year. We think we now have enough bodies at the table to create the competitive tension that perhaps was lacking in the past to get the deal done, and we are confident that the deal is going to move forward and be announced this year on a joint venture. What we're proposing, when you want to think about it from the partner's perspective, we're proposing a 2-phased earn-in. So we're not asking the partner today to commit to build a $6 billion plus project. We're asking the partner initially to come in and sole fund bankable feasibility so they can get to a construction decision. We're willing to give them a reasonable period of time to get that done. We think it could be done in 2 years. But then at that point in time, they need to then move to the next phase of the decision, which is to to commit to build the mine, to go out and secure at least 50% of the project's capital to the benefit of the joint venture, and to continue to sole fund another agreed dollar amount that takes them from a minority position that they may earn on the phase one of the bankable feasibility to a majority position. We know that whoever builds this mine is going to want to be in control. They're going to want to own more than 50%. So the question is, how much are they willing to sole fund in phase two to go from minority to majority for them to wind up in a majority position? Our goal has been the same for years. It's that we keep a meaningful interest in the project, and I'll define that from 40 to 49%, but not having to come up with 40 to 49% of the capital, and have whatever capital we have to provide come in towards hopefully the back end of construction. And that's the deal we're looking to do.
And Rudi, I'm going to just do a couple more questions related to the JV and KSM before we move to Jim. So just to get the KSM stuff out of the way. There's a question here saying that last year you were expecting to get the JV completed in 2023. Were there things that happened in 2023 that you can suggest are behind you now that gives you confidence in 2024?
Well, there was a bit of M&A activity that happened in the market last year that probably took two of the potential partners off the list because they were combining their entities. That obviously slowed things down from the perspective of a few companies. But I mean, look, was I confident we're going to get a deal done last year? I was sure hoping it. I was expecting it. It didn't happen, but it doesn't mean it's not going to happen. We continue to advance discussions. We had a lot of due diligence last year. RBC has done a great job in terms of keeping that due diligence active and dialogue ongoing. Look, our goal is to get a joint venture done. And as I've said for many, many years, terms are far more important than timing. And I think we're now in a market environment to get the deal done we want. And also the work we've done on the project over the past year plus also helps us with regard to that. We've looked at this project from the gold perspective, from the copper perspective. We've also now looked at this project from open pits only on all five deposits. All five of our deposits crop out. There is an opportunity for partner to come in and look at this in terms of even bigger throughput than 195,000 tons a day that focuses on five deposits all at once, where you might have a revenue split 50% gold, 50% copper, pretty much from day one. So we continue to improve the quality of the asset. There's no question that substantially started also was a big question mark. Were we going to be able to get enough work done to be in a position to get this designation? When we filed our application in January, it was not just our application. Along with that application were strong letters of support from the Tahltan Nation, the Niska Nation, the Gitxsan Nation, the communities of Terrace, the communities of Smithers, the communities of Stewart, and BC Hydro. And there's no question that some of the potential partners that may have looked at this in the past were questioning, okay, what happens if we go in, advance the project, and then the permits expire because they don't get substantially started? Well, we've taken that risk now off the table in our view, and we won't have that risk, which also is helpful in terms of getting the deal done. And that was probably one of the reasons why it didn't happen last year. There was still some uncertainty in terms of the whole concept of substantially started. You can imagine a company that's asked to come in and spend $300 million on bankable feasibility, or whatever the number is going to be, and then finding out that the permits expire within 6 months from that. They'd have to start the EA process all over again. That's why we went out and raised the dollars ourselves to do this work in a non-dilutive way. And we've now completed that work, which adds more certainty to the project going forward. And I will tell you firsthand, definitely has strengthened our hand in terms of deal discussions.
Thanks, Rudi. And then the one last follow-up just on the same related topic is, what is the process regulators go through for approving substantially started after application? And how long would you expect that to be to get a proper response?
So that's a great question. Unfortunately, I wish substantially started was a well-defined term. It isn't. The way it's written in the guidelines or in the rules is you basically have to do enough work on permanent infrastructure that's there for the life of the project. That's why we've been concentrating on roads, camps, bridges, power, fish compensation. There have been examples of projects that did receive substantially started by doing a lot less work than we've already done, namely Galore Creek to the north of us. That was funded by Nova Gold years ago, where they got that substantially started designation. That's now a joint venture between Teck and Newmont. And closer to home, the Kitsault project, which is a Mali project, got substantially started designation with a very, very small expenditure. But because they had the support of the Niska Nation, they were able to get that designation. So we think we've done enough work. I think if you look at the photos I walked you through, clearly we've done a lot of infrastructure installation there. We've spent a lot of money just on early site construction since we started those activities in 2021. We have $444 million Canadian into early site construction. We remain confident that the work we've done and the support we have will get the designation we're seeking.
Terrific. Okay, so Jim, let's do one over to you and we'll give Rudi a break for a minute because I sort of bombarded him there. And this one's for me because, as I said, we're still light on the macro questions, but I know that from listening to a lot of macro commentators, there's two main forecasting things that people always ask. One is direction and the other is magnitude. So do you have any sense? It's quite clear that we're into a new bull market. We're into all-time high territory here. Any sense as to where and how far and when we're going on this gold price?
Well, first of all, I'll take credit at our last annual meeting at Seabridge, so that goes back to June of last year, that I predicted $2,500 this year, and I'm pretty confident about that. We're getting it in a way that I would not have anticipated at the time. It's a very different bull market than anyone had reason to expect last year. Now, as to how far it goes, I'm going to give you the answer from our largest shareholder, Albert Friedberg, who is also one of the best investors in commodities and especially gold anywhere on earth. He said that we'll see a top of the gold market when they carry out the shorts on stretchers. And the problem is right now, we don't have very many shorts. In fact, as you note, or I mentioned to you before we started, the open interest has gone down 36,000 contracts in the last month on COMEX. There's just not enough speculation. Consequently, this price can go much higher. There's room to go. Secondly, the purchasers, the largest purchasers right now, are central banks. They are price insensitive. They don't care what they pay. They're paying in their currencies. Third, Asian purchasers such as the Chinese, it's not just the People's Bank of China. It is individuals, large, wealthy individuals. Why are they buying gold? Because the real estate market sucks. And their equities, stock market, have done poorly. So it is now the favorite investment in China. And I think we can see that happening in the rest of Southeast Asia. So we don't know where the top is in this thing. It's a little disquieting in a way to say that. But when you consider who the purchasers are, there of course will be a correction at some point, but there are thousands upon thousands upon thousands of investors who have been left behind. They are not on the train. They would like to be. Perhaps some of them actually feel quite foolish at this point. So the bids under the market will be very considerable. Even in places like Toronto, where gold has not been a favored investment for a couple of decades. So I don't know how high this goes. I don't think anybody does. But there's no reason to see or think that it's anywhere near a conclusion, given the nature of it.
I've heard many technical analysts mention that we've just broken out, so we really should be at the early stages of what's about to take place by most accounts.
And there are some issues in the treasury market where liquidity has been suspect, and so therefore The Treasury, U.S. Treasury, has gone to the very short term. They're raising money like a third world country. Very disquieting to people who've been long-term players of the bond market. The bond market, in one perspective, is really the alternative to the gold market. It should be something that you can count on to be relatively stable and to do well in difficult economic times. But the reality is that liquidity in the U.S. Treasury market has been getting very suspect, and I think you can see money going out of that market toward gold. So there are many things operating this time around that make it very different. And perhaps ultimately the most important is that gold is no longer strictly a passive asset held by central banks and barely referred to, if ever. It is now an active asset in a large part of the world. And if the dollar is not able to maintain its relative security and its ability to retain its value, particularly in something like the yen carry trade coming to an end, you can see another boost available for gold in those kinds of rearrangements in the foreign exchange markets.
Perfect. Well, let's move back to Rudi. It's a little bit related to KSM, so I'm going to finish this one up, even though I don't even understand the entire question. Please comment on the status of the MTT and that you are working on an alternative route that will avoid conflict with Tudor. So I apologize, Rudi. I don't know the specifics of that question, but hopefully you do.
Well, just by background, our design of KSM and our approvals are based around the building a 22-kilometer tunnel from the mine side of the project to where the mill is located in the tailings facility. We've received a number of authorizations from the government already. We have a license of occupation. We actually have permits to construct the portals at the different sites in the first 100 meters or so of the tunnel locations. We also have a mineral reserve that gives us exclusive rights along the trace of the tunnel for construction of that tunnel, where third parties are not allowed to interfere with our infrastructure or what we have there. Obviously, Tudor's not happy with this. They actually filed an application last year with the government to have them cancel all of the authorizations we have there. And by the way, we've had these authorizations for over 10 years. It's not like it was something new. We are willing, and have always have been willing, to sit down with Tudor to try and find a solution. But the fact of the matter is they do not have a project yet that we can even look in terms of where the tunnels might go relative to any infrastructure. They have a mineral resource estimate. They have not done a PEA. They have not done a PFS. They keep changing their mine plans, open pit, underground. They just filed a new technical report yesterday, which eliminated a lot of the previous material they had talked about as an open pit, which is no longer in the resource estimate. Yeah, we're happy to sit down and find an alternate route. Can you flex the tunnel and move it? Absolutely. But why would we move it when we don't even know where to move it to yet, because we don't know what the project may look like? They're a long way from that point, but we're happy to communicate and sit down with them and try and find a solution that they can be happy with. So we stand ready for that. We've opened up dialogue for many years now. We just haven't gotten to the point where they're willing to sit down and engage.
Thanks, Rudi. So back to you, Jim. There's one question that's come in on the macro side, and you definitely spoke to it. And I think it's an important component of what's going on with gold right now. And you've already broached it, but I'm just wondering if we get in. Their question is, in your opinion, how sound is the logic behind Chinese consumers buying gold as a hedge against deflation? And I think you articulated it well when you suggested that, their equity markets are a little bit fraught because the greatest entrepreneurs go missing by the government, and the real estate market, all of the big developers are in bankruptcy and liquidation at this point. And so the Chinese essentially don't have a lot of potential local options to put their money towards. Do we have any sense as to what type of scale this could be? I mean, I don't know myself, but do you? Because it seems to be important because there's a lot of them with a lot
Yep.
of money.
Yes, that's right. And they're willing to pay a premium, which is always a good thing to have in a market. No, I don't really have a sense of the size. It's a really good question. I think that's worth a bit of my time to track it down and find out what the potential is. You know, the big investment for a lot of Chinese investors was the so-called wealth products that were offered by the real estate developers. Essentially, they were debt-like, so they would raise money at 8%. They would promise a certain payout structure in terms of when interest was payable, bonuses under certain circumstances, and um, and then an ultimate redemption, usually 10 years down the road. There was an awful lot of that product sold, and there's an awful lot of scrambling going on now to prevent forfeiture. And it's going to bring the governments involved into them, and maybe not initially the People's Bank of China, but state governments, to make sure that losses are not taken. The Chinese investor can be very aggressive when it comes to enforcing their rights. They turn up in front of real estate developers and raise bloody murder, and so they should. So I think there's a great deal of fear about what happens to these investments. But for sure, that source of funding is drying up, and that um, form of investment is no longer on the table. So that's a major reason why gold has become more popular. No wealth products are being sold at this point. So I will do a little research on that and get back to you. I think it's a very good question.
It is, and one of the interesting aspects to it, I'm back, this is back to me as opposed to somebody on the line, but one of the interesting aspects to it, and it ties back to sort of my thoughts on Bitcoin. You know, you and I've talked about it extensively over the years. I am not a big proponent to Bitcoin myself, but I do remember when the wars broke out, and in the various parts of the world in the last 2, 3 years, and the absolute mobility for refugees and for people traveling with nothing but essentially the money they had, the real use case of Bitcoin. Because even if you lost your phone, you go and you plug in, you buy a new phone in the next country, you get a new SIM card, download your app, and you could actually have your money in your new location. Was a really good thing advocating for the value of Bitcoin. This on a grand scale for gold, the fact that, you know, millions upon hundreds of millions of Chinese people with nowhere else to put their money as a store of value now using gold, really shining a pretty big light on the commodity.
Yeah, that's right. Now, on the other hand, a group of Chinese investors are getting together to form an ETF for Bitcoin in China, and they hope to get approval from the central government. We'll see if that can happen. Bitcoin, yeah, but there's a role for Bitcoin, and I think anyone who wants to pit gold against Bitcoin and claim that they're natural enemies is wrong. I think they both have their uses. They appeal to different types of investors, and the gold becoming a more active asset is something that Bitcoin has failed to do. They are commercially less viable today than they were 3 years ago. Nobody's talking about buying a Tesla with Bitcoin anymore. But in terms of safety and security across borders, it has a value. No one should take it away from the Bitcoin people for what they've accomplished in that area. Gold, on the other hand, is money. I don't think Bitcoin is. It has the stability and the history and complete universal acceptance, which Bitcoin does not have, that it's in another category and doesn't have anything to fear from Bitcoin.
Terrific. Well, listen, I think we're coming in on a full hour, so I think we should wrap it up there. Jim, Rudi, really appreciate you taking the time to do this webinar with us today. I know Rudi would suggest to everybody that if you have further questions on Seabridge, please email him or the team at Seabridge. They are always happy to get back to everybody. Any final comments, Rudi?
No, Bruce, just appreciate the time. It's always fun doing these webinars with you. And maybe when the next one comes about, we'll be north of $2,500 gold, as Jim predicted about a year ago.
You just have to promise when you get your KSM JV done and you're big and famous and rich, you come back to Red Cloud and do a webinar post that, because that will be a very fun one as well.
Bruce, you and I go back more than 30 years together during times of wealth and poverty, so not a problem.
Well, thanks everyone for joining us today. That wraps up our webinar. Thanks everyone.
Thanks,
Thank
everyone.
you.